video, real quick video, because I've kind of debunked the gold theory as to where to invest during a recession. People say, well, if it's not gold and I shouldn't stay in the current investments that I'm in, what should I be doing? Where should I shelter in place? And so realistically, it's a loaded question. And the actual answer would be, it's complicated. So it should be different depending on your situation. Okay, and qualified investment advisors should be able to help you navigate this terrain that we're in right now with the bear markets breathing down heavy on us, heading probably towards a recession. What should we do so we don't lose all of our principal and have to dig as far to get out of the hole? In cases like this, when rising interest rates dramatically affect the bond market, and then we're also negatively affecting the stock market, so we have that double whammy effect where the stock market's going down and bond markets are going down. Where is a safe haven? You could, if you're going to be in the stock market, invest in more traditionally defensive companies or sectors of the market. So again, recession-proof is kind of a myth as from a company standpoint, but let's just talk about different sectors. So real estate could be one of those areas that is moving in a different direction. I'm not saying that it's not affected by the stock market, but it doesn't move the same as the actual stock market. So as we're raising interest rates and doing different things, it affects the qualified buyers that are looking for a house to buy. But if somebody is relocating because of a job, they're not going to sell their house where they live and not going to buy where they are moving to. Doesn't make any sense. So people are still going to sell and buy and move and do different things. They're just going to pay a different price, so either they're priced out of different real estate movements or transactions, but they're still purchasing real estate. You might also see a shift from actual home buying to more renting until it's affordable again. So different things like that might be going on. So real estate, again, is affected by the interest rate hikes and the negative stock markets, but it's not the same as what is actually going on in the stock market. So that's one area that you could look at as an alternative. Another alternative area that you could invest in is healthcare. So even though markets are going haywire, maybe people start losing jobs, things like that, but if you actually got sick or needed surgery, you're not going to put it off if it's life-threatening, right? So people are still going to continue to go to seek medical care. So healthcare providers, healthcare industry as a whole sometimes fare out a little bit better than perhaps some other industries. Let's call technology. So technology will tend to get beat up because if you have something that is tech-wise, whether it's a phone, a TV, a laptop, you might say, well, I'll put off purchasing one if you lose somebody's buying power, don't have enough money because groceries have gone up, things like that. And so you just see those companies slow down because those are more of a want, maybe not perhaps a need. So again, healthcare, real estate might be a little bit more of a safe haven than perhaps like technology. That's one way to combat a recession. The second thing is you can get into fixed items. So what I mean by that is if you actually purchase an individual bond, whether it's a government bond or a corporate bond, whatever it is, if you actually hold the certificate, even though they're affecting the interest rates, the Fed is raising interest rates, if you hold that bond to maturity, you won't lose any value. The newer issued bonds will be paying higher interest rate, but as long as you hold it to maturity, so if you buy it for $1,000 and hold on to it for 1 year, 10 years, whatever the maturity level is, and hold on to it for the whole entire period, you will get the full amount back, plus you would receive interest. And so that's another way where you, instead of being in a bond mutual fund or a bond exchange traded fund that's constantly cycling and perhaps losing money, If you had individual bonds, that's another area where you perhaps could save money and have it grow rather than be reduced. Hope this video helped. See you on the next one.